Hello students and welcome back. This is the second lecture in the financial statement analysis series. In the previous lecture, I had given you a brief introduction about how income statements and balance sheets are prepared. We went through an example in which we looked at certain transactions, certain business activities, and also how they impact the balance sheet and the income statement. Then I also showed you examples of the balance sheet and income statement of a company and what they look like. Today, before we begin with cash flow statement, I would like to explain certain other examples to you from the perspective of a company. So we are not looking at an individual proprietor now, we are talking about a company. And let's see how different would a balance sheet or an income statement be from the perspective of an individual and that of a company. When an individual brings in cash for his proprietary business, we called it capital. However, in the case of a public company, it would be called share capital. If you're looking at the balance sheet of a company, then you would find the share capital also categorized into different components. I would just talk about the two most commonly used components, which are authorized capital and issued capital. Authorized capital is the total amount of capital that any company can raise, and this is determined at the time when the company was first incorporated. Issued capital, on the other hand, is the amount of capital that the company has already raised. This is the money that has already been collected through the issue of shares to the general public. The company also can borrow through various means. If it borrows just simply from a bank, it will be called a loan. But if it borrows from the general public through the issue of debentures or bonds, then it will be called either debentures or bonds. Essentially, debentures and bonds means the same thing. That is, the company is issuing certificates, and through those certificates, it is raising loan from the general public, and with the promise of paying back the loan after a specified period of time and also paying a fixed interest on those. You may also have heard a term which is EPS. Now, EPS is earning per share. When I gave you the example of a proprietor, we used the term profit. And we also said that the proprietor has right over this profit, and we added it to the capital of the proprietor. However, in the case of companies, again, there is profit that you receive at the end of a financial year, but there are a lot of owners in the case of a company. This profit has to be divided amongst those owners. And that is what EPS stands for. Now, there would also be a term called dividend. Dividend is the amount of profit which is distributed to the shareholders. Now, you would say that why is the entire profit not distributed to the owners? Now, again, there are a lot of reasons why the entire profit is not distributed to the owners in the form of dividends. And the reason is that sometimes it can generate more benefits for the shareholders if it re-employs the profit back into the business. So you would see that most of the new companies, most of the growth companies would not be paying out any dividend. In fact, they would be keeping the profit within the company in the form of retained earnings. If the entire profit is kept in the company as retained earnings, then this money is essentially re-employed back into the business so that it can earn more income over the next period for the benefit of the shareholders. This retained earning is added to the share capital in the balance sheet. In the balance sheet, again, on the asset side, yesterday I showed you that assets were divided in current assets category and long-term assets category. Current assets would most likely comprise of cash, amounts receivable, any short-term investments that the company may have, and long-term assets of the company would have those assets which will give their economic benefit over a longer term, such as land, building, machinery, equipment, or any long-term investments that the company has. You may also remember that I mentioned a word depreciation to you. Now, most of these long-term assets will be depreciated over time or amortized over time. So, amortization is a word that is used more commonly in the US, and depreciation is the word that is used in most other countries. And what is this depreciation? Depreciation is the value of an asset which has been utilized through that year. Say, for example, if a company buys a machinery for $25,000, it is possible that the machinery will last only for 5 years, because after 5 years it may either become redundant or it may stop working completely. So an estimate is taken for the useful life of the machinery, any scrap value that may be derived from the sale of that asset at the end of its useful life, and with this information we determine what would be the depreciation of that particular asset. Say now, if this particular machinery, which has been bought for $25,000, will last for 5 years and it will not have any scrap value, that means it will be diminished to 0. So we have to divide this cost of this machinery over the 5 years, and it simply comes out to 5,000 if we use the most basic depreciation method, which is straight line depreciation. So while my machinery cost will stay on the balance sheet at 25,000, every year an amount of depreciation equal to $5,000 will go on the income statement, and that income statement depreciation will also be reflected in the balance sheet year on year, thereby reducing the value of the asset also on the balance sheet. Now, after giving you this basic information, let's move on to understanding the requirement of having a cash flow statement. Let me give you a couple of examples in the case of a company, and then we will see how these activities are going to be reflected on the profit and loss account and the balance sheet. So here I'm making two columns, one for the profit and loss account or the income statement and the other for the balance sheet. Now let's look at three different examples. In the first case, let's suppose that the company makes sales of $50 million. So this information will go on the income statement because this is the revenue and it comes out of the operations of the business, out of the day-to-day trading of the business. So the 50 million of sales will be reflected on the income statement. Now, in the case of the companies, what you should be aware about is that all transactions do not happen in cash. Most transactions happen on credit and cash is collected over a period of time. Now the question is that should I show these sales on balance sheet also? And the answer for this is no. We cannot show the entire sales in balance sheet because we are not talking about cash sales entirely. So let's say at the end of the year for this transaction, the company has been able to collect cash of 10 million and the remaining 40 million is outstanding, and we would call it accounts receivables, which is also an asset. So both of these items will appear on the balance sheet. So we have cash of $10 million and we have accounts receivable, I'll short it as AR, of $40 million. Now let's look at another activity. Let's say this company buys a machinery for $5 million. And let's also assume that this machinery will have an annual depreciation of $1 million. As I explained to you yesterday, this $5 million utilized in an asset purchase will not be put on the income statement because this does not involve trading. It is an investment that the company has made. However, because an asset has been purchased, it will appear on the balance sheet. However, one component of this machine will show on the income statement, and that is depreciation, because this is only for the 12 months period that we are talking about. We will also put accumulated depreciation on the balance sheet. And the final cost of the machinery or the book value of the machinery at the end of the year on the balance sheet will be 4 million. Now let's take a last example and say the company is raising debt. That is, the company is borrowing funds from the market and it issues debentures of $50 million. Now this $50 million issue of debentures will not have any impact on the income statement unless and until there is a payment of interest. So let's pay a little interest also and see how that happens. Suppose interest is paid on these debentures and that comes to 2.5 million. So this interest payment will go on the income statement. And this information will come on the balance sheet on the liabilities side. So while these are assets, we also have liabilities. And apart from any other transaction that may have happened in the past periods, let's see that we have a debenture amount added as 50 million. We also have cash dispersal here. First when machinery was bought for $5 million, and later on for the payment of interest for $2.5 million. Which brings it to $2.5 million. And we also add the cash that has been received via the issue of these debentures, which is 50 million. So if suppose these were the only transactions that happened through the year, then the business would have made a profit of $46.5 million. And this company would have a cash position of $52.5 million at the end of the year. Usually investors would only make an investing decision on the basis of this information. Investors just go far enough to look at the balance sheet and the income statement. If the company is making profits on the income statement, for example, in this case, it is 46.5 million, they would go ahead and invest in this company thinking that it is a profitable company. And also because it has such a huge cash balance with itself, most investors would assume that it is a good, strong position in which the company is. If I just look at the income statement and the balance sheet, it may appear that I had a sale of 50 million and I have collected approximately a similar amount over this period. So in one way, it may give an impression that my entire sales have been collected through this period. It will not cover the risk that if there is an economic downturn and if one of my big buyers goes bankrupt, then he may never end up paying me any money on those outstanding receivables which I have on my balance sheet. So this is where comes the need of cash flows. If I have a cash flow statement to look at just after I reviewed the balance sheet and the income statement, then let's see what it will look like. So if I have a cash flow statement down here, then all my cash flows will show here. The first cash flow was a cash collection of $10 million. And because this is coming out of the core operations of the business, it will be termed as operating cash flow. In the next transaction, there has been the purchase of a machinery, there has been an investment, and $5 million has been spent on that investment. I would term this as an investing cash flow, because it is not involving any trading. It is not involving any operations of the business. It is the purchase of an asset. So in the case of an investing cash flow, it is an outflow of cash. The way it was an inflow of cash for operating cash flow, we would say in the case of investing cash flow, it is an outflow of cash. An outflow of $5 million. And lastly, the issue of debentures. Through the issue of debentures, there has been an inflow of $50 million for the company. And because this is a financing activity, and when I say financing, I mean we are trying to fund our company. It can be either through share capital or it can be through loans or borrowings. Because we are trying to finance our company, it will be called a financing cash flow. So there has been a financing cash inflow of $50 million. But at the same time, there has also been a small outflow of $2.5 million for payment of interest, and that will also go in the financing cash flow. So the net inflow on the financing cash flow would become $47.5 million. And then there will also be a net cash position, which will come to $52.5 million. So you will notice that this cash position matches our cash position on the balance sheet, which is $52.5 million. However, the thing to notice here is that the income statement shows that there has been a business of $46.5 million. However, when we look at the operating cash flow, there has only been an operating cash inflow of $10 million. So there is a huge discrepancy between the income statement message and the cash flow statement message. I will take you into a little more detail on the cash flow statement and why it is important for an investor to review a cash flow statement in addition to looking at the balance sheet and income statement in the next lecture. Thank you very much. I really enjoyed giving this lecture to you. I hope you liked it too.